Sanger, who joins in to talk about how the equity markets have been shaping up so far. Arvind, good morning from India, and thanks for joining us. It seems to be a purple patch for the markets now. Everything that has to go well is going well. Do you think something's got to give, or is this uptrend intact?
Well, I mean, for now it is, and I think unless there's any global negative surprises, it seems like on the India front, the earnings have turned a corner. The economic underpinnings look good. GST rollout, while it looks like there will be some teething issues, and I think some of the information is starting to come out about the tax rates and also some of the implementation mechanisms. And while I wouldn't call it a perfect, kind of a setup, but it certainly is a huge step forward, and hopefully over time some of the tax and implementation things will rationalize. But in any case, from a market standpoint, that does give hope that over time it'll drive economic efficiency and add to growth. So I think the earnings are turning, the growth outlook is looking good. Global growth, let's be clear, global growth is better than it was last year. That's why the Fed can raise rates. That's why the ECB can consider starting to taper their own QE. So I think the global backdrop is better, and India backdrop is better. So I think all of those are good for the market.
Okay. Yeah. Okay, just coming on the earnings front, the street is expecting a 20% EPS growth in the coming year. Is that likely according to you, considering that GST could be a disruptive factor, at least for the first half of the year? And if it doesn't play out, can it be a dampener for the Indian markets in the up move towards the end of the year?
I think GST can certainly be a bit of a question mark in the first half of the year. But I think in the second half of the year, if we're talking about looking at it for 12 months, in the second half of the year, the GST should be in the rearview mirror, and the earnings growth should be more clearly visible. So I think 20% is not at all a stretch, but could it be, a little less than that in the first half and more than that in the second half? I think that's quite likely, that, the first half is a little bit below that 20% level, and the second half is above that 20% level. So all of that would certainly bode well for the markets over the next 12 months, over the next 8 or 9 months of the remaining fiscal year, but 10, 11 months. But it's never a straight line.
Okay.
So, I'm sure there'll be challenges along the way.
Oh, yes. But Arvind, how would you just look at the 3 years of the Modi government and compare it in terms of political economies to other EMs that you invest in? Does it look like India would offer the best opportunity to invest simply because of the amazing political stability and the reform record? Where would India be in your pecking order?
Well, I think that, I think India has a lot of benefits for it. It has the best demographic dividend. Political stability is pretty high in China, too. So, it's a different kind of political stability, but it's there. But that's, and obviously there is no political stability in Brazil, and there's political stability in Russia. So, when you look at major emerging markets, political stability, India is not, is outstanding.
Okay, reform record.
But I think there is stuff going on in terms of economic improvement, and you have interesting things going on, like the direct benefit transfer, which is building on what the previous government did, and the fruits of that are going to come in the coming years in terms of improving the government's budget deficit because of better delivery of subsidies. You have GST, which creates an integrated market, which was not existing. So there's a lot of stuff going on in addition to the demographic dividend, which is unique for India amongst the major emerging markets. And on top of that, what you mentioned, which is not unique in emerging markets, but it's unique for India to have the kind of the political stability that it has not had for a long time. So you add all those factors together, and all of that makes India relatively uniquely positioned in terms of emerging markets.
Sonia began this conversation by asking whether we are on the throes of a rating upgrade. Basically, will that make a very big difference to you as an equity investor?
Not really. I mean, the rupee is already strengthened. So, in a sense, the rating agencies are not necessarily the drivers of it, but they can be drivers of instability if they do a rating downgrade and that causes money to leave. but money is already coming in, and a rating upgrade would just confirm what's already going on with the rupee and with funds flow. So I don't think it's as important or as significant as all of the other factors. Or in fact, it's not meaningful to us at all in terms of our equity investments.
Oh, that's interesting. And good you pointed that out. You know, when we were analyzing the Modi government's 3-year report card, we were discussing how the only elephant in the room now is the NPA resolution mechanism that has not worked yet, and the whole banking system that's still sort of in collapse mode. Do you think that this is the time to be sort of buying into any of these banking stocks, or is this a space that you would still avoid, the PSUs and the corporate-facing banks?
Well, I think, this is unfortunately a topic we've been discussing continuously for the last couple of years, and it's always been, do we or do we not buy? And we've stayed away from all the lower quality public sector banks. I would say some of the private banks, like ICICI, Axis and others that have lagged, I think we are at a stage where the NPA worst of the problem loan recognition is behind us, but that doesn't mean that because they've used up a lot of their allowances that they will not be. The credit costs will still remain elevated, but new shocks in terms of new problem loans being recognized is probably the worst is behind us. And therefore, in that sense, it starts to become interesting. But I think for them to really work, we need to see the loan, growth cycle revive. And one of the other disappointments in the Indian economy is that the private sector investment cycle still remains extremely sluggish, and it's partly caused by the NPA problem, but partly caused by still not enough companies feeling like capacity tightness is enough or pricing is enough that they need to add in new capacity. So I think that's one of the challenges that remains, but I would say that some of the lagging private sector banks certainly are looking greater interest to us.
Okay, so you started the conversation on an optimistic note, Arvind. So tell us, from here on, what is the extent of upside that you see in the Indian markets, and what would you recommend as a buy right now at these levels?
Well, that's always the challenge. We're still finding, mid-cap companies that are facing specific challenges, that have lagged and that could have a nice cycle going. I think the thing to think about is that we're going to see over the next 3-4 years GDP growth of 7 to 8%. Let's put a bracket around it. There's going to be there is going to be a lot of wealth creation in the middle class, and there's going to be, whether it is cars or air conditioners or other we've talked in the past about cement, although the stocks have had a great run. Some of the infrastructure spending that the government wants to companies associated with that, and even real estate, which has been dead as a sector, not the stocks. The stocks have done well recently, but the sector as a whole in the economy has been dead for the last few years. With all of the new rules coming into effect, the established large players should benefit at the expense of the less organized and maybe less professional companies. So that would be another sector which has been lagging for several years that could see signs of life.
All right, Arvind, we'll leave it at that. The markets have welcomed the 3rd anniversary on a strong note. Thank you very much for joining us with your